Welcome back to Investing Talk Podcast.
Today we're looking at TMC, the metals company, really focusing on this, high-stakes future of mining play. It kind of connects the whole EV transition directly to the deep ocean floor.
Right.
This company, it's essentially a pure-play resource disruptor. They're trying to secure critical metals, nickel, cobalt, copper, manganese, by collecting these polymetallic nodules from the deep sea.
It's definitely a compelling story, especially with, the global scramble for exactly those battery components. As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, just leave it in the comments below.
So let's get into the analysis of the metals company. Look, the first and honestly the most crucial point here is the financial reality check. This is a pre-revenue company, still in the development stage. They are burning through cash at a, prodigious rate to get the tech developed and secure those exploration rights.
That's really the key, isn't it? That relentless cash burn. I mean, the trailing 12 months net loss is pretty sobering, about $131.5 million.
Yeah.
And when you've got an earnings per share of negative 0.38, well, you're basically running a cash incinerator at that point. Future profit isn't just about scaling up. It really hinges on getting a massive green light from global regulators. And, that might never actually come.
Precisely. And look, while the market cap is sitting up there, north of $2.3 billion right now, kind of buoyed by this whole narrative of resource scarcity, you've just got to remember that negative free cash flow. It's like a ticking clock.
Right.
They have to rely heavily on equity financing. This isn't just theory. This continued need to raise capital by selling new shares, it creates a really severe dilution risk for every single existing investor.
Yeah, dilution is a killer.
The company is literally trading that long-term dilution risk just for some short-term operational runway.
We've seen other development stage companies manage this, sure, but usually they have a much clearer path to revenue. The bull case here, it has to be incredibly compelling to justify taking on that level of risk. So what is their real competitive moat here?
Well, the moat isn't really based on cost structure. It's more about geopolitical positioning and resource scarcity.
Right.
It's optionality, really. The EV transition needs enormous amounts of nickel and cobalt.
No question there.
But what's fascinating is that basically every new land-based nickel project, it faces years of local community pushback, escalating environmental rules, and significant political risk.
Yeah.
Especially, given how supply chains are concentrated in specific, sometimes, let's say, difficult regions like Indonesia.
Okay. So their advantage isn't just the tech itself. It's potentially being insulated from all that resource nationalism we see cropping up.
Exactly. TMC holds exploration rights in the Clarion-Clipperton Zone, the CCZ. Now, for listeners who haven't followed this super closely, the CCZ is this huge region in the Pacific Ocean, just incredibly rich in these polymetallic nodules. They have a kind of first-mover advantage and regulatory head starts in this pretty unique area, which is governed by the International Seabed Authority.
Okay.
So they're basically betting that extracting metals from the seabed, it's technologically really challenging, is ultimately less geopolitically messy than dealing with unstable supply chains on land. The scarcity of these materials means the potential payoff, if they solve the deep sea challenge, is just astronomical.
That really sets up the high-risk, high-reward tension perfectly, doesn't it? Okay, now let's unpack the recent, stomach-churning volatility we've seen. The price action has been just wild.
Okay.
We saw the stock absolutely rocket up to $11.35 just a few months back in October 2025. That was an incredible momentum run, but it's corrected really sharply since then, crashing back down to the current price around, $5.73.
Around there.
That's a massive loss of value in a really short time.
Yeah, and that kind of volatility, 50% plus swings, it just tells you this is a highly speculative vehicle. It's driven purely by shifting narratives, not by fundamentals right now.
So what triggered the crash?
Well, the crash was definitely made worse by a few things. First, their Q2 earnings back in August, they missed the analysts' expectations, and that almost always triggers momentum selling.
Sure.
But maybe worse, we saw a pretty heavy insider selling pickup late August and into September. 2 key executives selling shares.
Oof. That insider selling is always a massive red flag, isn't it? When management starts selling shares, especially after a big run-up like that, it immediately raises governance questions. I mean, why should a retail investor hang on if the people closest to the operation are locking in their gains?
It absolutely impacts market perception, you're right. And investors should definitely take note of that. However, you do have to balance that negativity against some concrete regulatory wins that actually provide some tangible project momentum.
Okay, like what?
September brought a major positive development. The National Oceanic and Atmospheric Administration, NOAA, confirmed full compliance of TMC USA's offshore exploration license.
Okay, NOAA compliance. Why does that matter so much in the grand scheme? Isn't this mainly an international play?
Well, yes, but it matters because it proves they can meet the necessary governmental standards for their exploration licenses, at least within the U.S. jurisdiction. It keeps their project timelines intact on that front, and it reinforces the narrative that they are working closely with established government bodies, which is just crucial for legitimacy.
Right, optics matter.
That said, the main regulatory hurdle, it absolutely remains international. The ongoing scrutiny, especially regarding the environmental and social impact research tied to deep-sea mining, it's intense.
Let's lean into that environmental side for a sec, because this really seems like the biggest existential threat, doesn't it? What are the specific arguments holding up commercialization?
Yeah, it's huge. Environmental groups are really focused on the impact to the benthic habitat. That's basically the life forms living on or near the seabed. They argue that scraping these nodules off the bottom fundamentally disrupts a really unique ecosystem. And frankly, we don't fully understand the long-term consequences yet.
Okay.
And this pressure, it's led to a major deadlock within the International Seabed Authority that's the body responsible for setting the commercial mining codes.
So the company's entire future basically hangs on whether they can prove their collection method is sustainable enough to satisfy global demands for protecting that habitat.
Wow. The ultimate irony would be the green transition itself killing this potential deep-sea green resource.
Precisely. It's a really complex ethical and scientific challenge. Okay, moving on, though, let's talk short-term catalysts. Over the next, say, 3 months, the market is going to be laser-focused on any updates suggesting the regulatory path or maybe strategic paths are clearing up. Right. We've got 2 pivotal scheduled events coming up pretty quickly. First, Q3 earnings release. That's November 13th, 2025. Now, since no revenue is expected, the actual numbers aren't really the focus, are they?
No, not at all.
The market will be listening really intently to the forward-looking commentary. Updates on project milestones, capital allocation plans, any hints about initial commercial cash flow timelines. That's what matters.
Exactly. And the second major scheduled event is the window for major ETF rebalancing. That happens around mid-December 2025.
The rebalancing shuffle.
Yeah. Since this stock is pretty liquid and it's tied into the whole critical minerals sector, index adjustments can generate huge buying or selling pressure from sector funds just trying to match the index weights. It injects volatility that has, frankly, nothing to do with the company's underlying performance.
Always something to watch. What about the more speculative drivers, the whispers and rumors swirling around?
Well, looking a bit further out, January 7th, 2026, that's an important, though kind of backward-looking date. That's when the institutional 13F filings become public.
Right, the 13Fs.
For the listener, these filings basically reveal where the quote-unquote smart money, the big hedge funds, institutional investors, where they were positioning themselves during all that extreme volatility late last year. It gives us some insight into who the big backers might be.
Okay. And what are the current rumors sort of driving sentiment day to day?
Well, there are 3 big ones that seem to consistently float around social media and, market commentary. First, ongoing media speculation about a possible strategic partnership or maybe a joint venture with a major EV or battery manufacturer.
That would be huge.
Oh, absolutely.
Yeah.
Securing a major customer before commercialization. That would instantly validate their resource reserves. Second, there are these unconfirmed reports about them possibly bidding for new offshore exploration licenses, which would expand the scope of their future operations.
Mm-hmm.
And third, given the pretty high short interest in the stock, there's always that ever-present social media chatter about a potential short squeeze scenario if some of these upcoming catalysts land positively and trigger a sharp upward move.
Okay, classic squeeze potential. Let's talk technicals for a moment. We're currently sitting around $5.73. Now, we're below the 50-day simple moving average, which is up around $6.82, but we're still firmly above the long-term 200-day SMA, which is down at $4.60. For the listener, what does it mean when the stock is sort of caught between those 2 key lines?
Well, it basically means the intermediate momentum has completely stalled out since that October high. It confirms that the speculative fever, has definitely cooled off. However, the long-term trend, structurally, it still remains positive. That suggests that maybe patient capital is still holding the line.
Okay.
And the indicators that kind of confirm this pause, the relative strength index, the RSI, it's sitting here 40.21. That's neutral, maybe slightly bearish. Tells you the engine just doesn't have much steam right now. And we also see a negative May CD reading.
So the stock is effectively dead money right now, unless some specific news hits it. And given the history we just talked about, we have to mention volatility again.
Oh, absolutely. The volatility has been extremely high, 17.7% in just the past month. Investors really need to be prepared for the expected trading range in the next quarter, which looks pinned between that long-term support around $4.70 and resistance up near $7.
Right.
Breaking out of that range, either up or down, it's going to require a major catalyst. Either something positive, like a partnership, or negative, like a big regulatory setback.
This really brings us back to the core investment risks. If the bull thesis is all about that geopolitical moat and resource scarcity, what are the, say, 3 biggest danger zones that could potentially wipe out an investment here?
Okay, number one is definitely execution risk. And this isn't just about burning through cash. It's really about the technological scaling. They're essentially betting that these massive, highly experimental collection systems they've designed, that they'll actually work consistently, thousands of feet underwater, harvesting millions of tons of nodules efficiently.
Yeah.
This is basically unproven science at commercial scale.
That's a huge gamble on the tech itself. Okay, what's number 2?
Regulatory risk. This, I think, is the highest existential risk. The sheer uncertainty over deep-sea permitting, the pace of the International Seabed Authority's rulemaking process, that's the ultimate throttle on the entire business. Changes in environmental laws, perhaps pushed hard by powerful NGOs or even rival nations, they could derail the whole project indefinitely.
A complete showstopper potential. And finally, the market itself.
Market risk. Yeah, they're vulnerable to massive swings in commodity pricing. If nickel and cobalt prices were to drop significantly, it could make the whole deep-sea resource less economically attractive compared to land-based options. Yeah. But more importantly, as we've seen, they've already demonstrated extreme market volatility, suffering that 50% value loss within weeks recently.
Yeah.
This stock absolutely requires professional risk management. It is definitely not a set it and forget it. It's kind of long-term hold for most people.
Okay, so given all this peril, the $131 million annual loss, the dilution risk, the huge environmental uncertainty, how is it that the analyst consensus is still a strong buy rating? With an average 12-month target of $6.88, why are analysts seemingly so bullish if this is basically an unproven science project facing massive hurdles?
It's because they're pricing in the optionality of regulatory success. The underlying thesis is pretty simple. If TMC successfully navigates all those regulatory hurdles and actually secures commercial licenses, then their reserves in the CCZ, they instantly become one of the most strategically important and crucially geopolitically secure sources of EV battery metals on the planet.
Ah, the if.
Exactly. The highest analyst target is still sitting way up at $11. That suggests analysts view this as a potential multi-bagger if the narrative plays out as hoped. They aren't betting on current earnings, obviously there are none. They're betting on future resource scarcity and that critical first mover status.
So position sizing here is just absolute critical then. Who is this type of investment really best suited for?
Yeah, extremely critical. Look, it probably suits 2 very distinct groups. First, you have the long-term, very risk-tolerant investor who wants pure exposure to the whole electrification megatrend and true resource disruption. They're likely viewing this as a sort of 10-year play.
Okay.
Second, you might have the short-term momentum trader, someone skilled at capitalizing on the high volatility and that defined risk-reward setup we talked about between roughly $4.70 and $7. They're looking to play the swings when regulatory news or those partnership rumors hit the wires.
And for everyone else?
For pretty much everyone else, it's probably just a fascinating story to watch from the sidelines for now.
The short-term trajectory of TMC, the metals company, it seems, will be entirely driven by whether those key regulatory milestones and maybe strategic partnerships actually materialize before the next cash flow update. That would confirm the path out of this highly speculative pre-revenue phase and maybe start to justify some of that analyst optimism.